Hello everyone, and welcome to our webinar on the recent ATO publications on Division 7A and Section 100A. For those that don't know me, my name is Adrian Bailey. I'm one of the principals at Cleary Hoare, working and living in Sydney. Also on the screen at present is Paul Mackenroth, one of our other principals who lives in Brisbane. In terms of the presentation today, we are going to be going through the publications that have come out and then also talking about some aspects that you should be considering in your practice in relation to them. We're going to split the presentation today. Paul's going to cover off on the first part, dealing with the Division 7A ruling or backflip, depending on which way you look at it. And then I'm going to go through the three Section 100A publications, so the taxpayer alert, the ruling, draft ruling, and the practical compliance guideline. We've read the rulings since when they came out. We've given it a reasonable amount of thought over the last month, so hopefully we can provide not just an overview of what they say, but perhaps some practical comments and tips. In terms of the system that we have running today, you should see over on your right-hand side a couple of icons that you can click on. One of them is the chat button. If you click on that, you could submit questions. We'll each be moderating each other's presentation in terms of questions. So when Paul's talking, I'll be looking after questions and vice versa. We've got a plan to have a bit of a break in terms of break for questions at the end of Paul's presentation on Division 7A. And then I'll be talking about 100A. So if you do have queries, questions, comments, suggestions, chuck them in the chat box and we'll address them then. You should also have a files button over on the right hand side. If you click on that, you can download the presentation today. If you miss out doing that during the presentation, you can also do it. You can also access them in the feedback email that we'll be sending out at the end of the day. They'll have a copy of the slides attached to that. On that point, clearly you'll be receiving a feedback email. If you could take the time to complete that, we take all feedback on board, and particularly in relation to presentations that people would like us to give. Most of the presentations that we have via webinars are from suggestions. Other aspect of today is that this will be recorded and will be made live, available on our website a little later on today. So just keep that in mind in terms of questions or comments. We'll moderate them anyway, but obviously no client names or anything like that, because it will be available on our website for anybody to watch. So I'd like to introduce Paul Mackenroth. As I said, he's based in Brisbane, works predominantly in Queensland, but he's going to take us through the new Division 7A ruling issued at the end of February.
Yeah, thanks, Adrian. So in relation to the draft ruling for Division 7A, I've got on the first slide there both sets of documents we're going to talk about today with both papers. But the changes that have come through in the draft ruling really are, from our perspective, designed because the Commissioner is sick of waiting for government to legislate the changes to Division 7A. The changes that have been made under this draft ruling really take out the subtrust option, except in certain limited circumstances. And from our perspective, the ATO's has had an ongoing program of allowing subtrusts that have come to an end to convert to loans. That was a good option for a lot of people because it meant, they could defer the repayment of the principal at the end of a subtrust period. But effectively what the new ruling does is change the view of how a subtrust can operate and when it can operate, and when a subtrust option actually changes into a loan rather than being a strict a loan under Division 7A, I should say, rather than being a strict subtrust. So there is a rather substantial backflip, but it is in line with pretty much what the government wants to do in terms of legislating changes to Division 7A to make UPEs to corporate beneficiaries loans within the definition of Section 109D of the 1936 Act. So it was released last month now, and I know, speaking to a couple of accountants this week who are all told me they're going to be online today. This is probably the third or fourth that they've attended, so I think everyone's looking for a bit of wisdom. I'm not so naive to think that everyone's here for Division 7A. I'm sure that most people are here for the next paper by Adrian, because that's where I think most people have been a bit aghast at the rulings. So, but obviously this is an important change that we need to be across. So generally, Section 109D talks about loans by companies to shareholders or related parties, and there is an extended definition of what a loan is in subsection 3. Subsection 3B is the one that the ATO extends to UPEs to private companies. So they say that a UPE to a private company is a form of credit or other form of financial accommodation. The second part of that paragraph is where they really hit it home, being that they say there is a financial accommodation by the company to the trustee of the trust or to other parties by not calling through a UPE. So once you become aware of the UPE, failing to call for that is the form of financial accommodation to the trustee or to other parties. So that's where that change is nothing new, because that came out in the practice statement and the tax ruling from 2010. So we've been dealing with it for a long time, but the view has changed with a couple of aspects. So we'll talk about those. So this ruling is really it's a culmination of the first set of rulings, but also has a few changes, like I've said, and it is designed to deal with two circumstances. Okay, where a private company is made presently entitled to income of a trust, and that trust entitlement remains unpaid, obviously after their knowledge of the entitlement, and the trustee sets aside an amount and holds it on a separate new subtrust for the exclusive benefit of that private company beneficiary. So where a UPE arises and it is not paid, the Commissioner says that is a financial accommodation by the company to the trust, where the company has knowledge of the amount and can demand immediate payment of it. And obviously it doesn't make that demand. So the Commissioner has also clarified, or I guess at least gone a bit further than what he did in those earlier statements, and has said that the knowledge, if there is the same controller, they like the words controlling mind, if there is the same controlling mind in both entities, that being the trustee of the trust and also the corporate beneficiary, which is generally the case in, I would say, 99.9% of cases, then the time when that company is made presently entitled to income will be when that knowledge has arisen in the company. So there are some distinctions on when that knowledge element actually comes about, because we might make a trust distribution resolution that says a company gets $10,000, or conversely, we might say it gets the balance of net income. Obviously, there are two different elements there. One is a hard figure. The other is a figure yet to be determined, and that will determine the timing at which that corporate beneficiary has knowledge and can demand immediate payment of that present entitlement. So that's kind of this slide, really looking at that timing aspect. So if the trustee distributes a set amount of money to a corporate beneficiary at 30 June, that entitlement is known immediately. So it is known and not called for as at 30 June in that particular financial year. Whereas the alternative, where the balance of net income or a percentage of net income, that won't be known for some months when the trustee finally determines what the net income of the trust is for that particular financial year. So that does have some bearing on when the financial accommodation arises and in what year that first repayment needs to be made. It's pretty much, I've talked to this slide already. The second option, and this is where a lot of the change has come through, is where there is a subtrust. So under PSLA 2010-4, we could put in place a subtrust option whereby we paid, there were different options. You could pay interest per year with the capital paid at the end of the 10-year term. Although those options are now gone, they no longer will apply. What the Commissioner says is that financial accommodation occurs where all or part of the subtrust is used by the private company beneficiary shareholders or their associates, and the private company has knowledge. So what that really means is that the trustee might credit an amount of money or a percentage of the fund and put it on a subtrust for that corporate beneficiary. If the trustee uses those funds in its business or in any other activity, that will be the time at which those funds are deemed to be a financial accommodation. Now, the circumstance doesn't change if there is an arm's length arrangement, and that's where there is a significant change. So say, for example, the trustee distributes income to a corporate beneficiary and that amount is put on a subtrust. If that amount were lent at commercial rates to a related party or to the main trust, the Commissioner says, regardless of the commercial rate of return of both principal and interest, that is still financial accommodation and converts to a loan. So that's a fairly significant change. Now, the amount that's put on subtrust can be strictly put on a subtrust, but once the funds are used by anyone who would be a related party, that is the time where it converts to a loan. So that is, as I said, that's a substantial change from 2010-3, as well as the fact that the Commissioner's allowance under PSLA 2410, which allowed you to put it on a subtrust for a period and pay interest per year, that is now gone.
Excuse me, Paul, can I just jump in with a question?
Sure.
Question from Abhishek, and I think you just answered it in your presentation, but just to double check, can the UPE be paid by way of interest-only loan at the ATO benchmark rate of interest? The trust used the money to buy a rental investment property and can claim interest paid to the beneficiary company against rental income.
Yeah, I mean, when you say put it on a loan at the interest, effectively what the Commissioner would say is that is a Division 7A loan that needs to have in place a Division 7A loan agreement for that subtrust amount. So that can happen, but if no Division 7A loan is put in place when that amount of money is used to purchase that commercial property, then a deemed dividend will occur. So that the short answer is you have to put in place a Division 7A loan at the time those funds are used to purchase the commercial property.
Paul, that's all for now.
Thank you. So again, in terms of the subtrust option, the timing around when it converts from a subtrust to a financial accommodation or a Division 7A loan is when the private company beneficiary has knowledge that the subtrust is being used by related parties. Obviously, if the subtrust were lent to third parties, at commercial return, then it's not a form of financial accommodation, and all returns from that loan to the third party would go to the corporate beneficiary, effectively like a fixed trust. So it's purely about where the funds are lent or used by a related party of the company. Again, that same directing mind or controlling mind will impute knowledge by both parties. So if the trustee has the same or similar directors, or even one director who is the same between the trustee and the corporate beneficiary, the minute the trustee uses those funds for a private purpose or for a purpose of the main trust, then that knowledge will be imputed to the company and will signify the conversion from a subtrust to a Division 7A loan. So, look, we all know that to avoid a deemed dividend, we need to have a number of, there's a couple of different options. Obviously, we repay the money or pay out the UPE in this circumstance. If we pay out the UPE to the corporate beneficiary, then there's no problem. But if we can't do that, we need to put in place a complying Division 7A loan agreement. And there's different timing aspects as to when that needs to be in place. And that comes back to the time at which the subtrust converts to a loan. And again, it goes back to, do we put a set figure in our distribution minute or a figure that's yet to be determined? And I've got three of these. They're cut and paste from the ATO's document, and it basically highlights the difference between when we identify how much of the net income the company is entitled to. So in the first scenario, where the company is entitled to 100% of the trust income, well, the determination of how much that actually equates to doesn't happen until a later time. So in their scenario, it doesn't happen until the 1st of August in the 23 year. So at that time, the company is deemed to have provided financial accommodation because they're aware of their entitlement. They're aware of the amount of the entitlement. They're entitled to call for the money, and they haven't done so. So the commissioner says, well, that is the provision of financial accommodation. And what that means is by lodgement day, so that I guess that loan occurs in the 24 financial year. So by lodgement day, which is May 2025, we need to have either paid out the amount or put in place a complying loan agreement. And in that same financial year, so 30th of June 2025, we need to have made our first minimum repayment under that complying loan agreement. So again, kind of gives us that bit of 18-month leeway from the conversion from a UPE to a financial accommodation loan to when we have to have our loan agreement and pay our minimum repayment. So this option is where we are made presently entitled to a set sum. So if we're made presently entitled at 27 June, that could be 30 June 2023, because our entitlement is set at that date and the knowledge will be imputed between the trustee and the corporate beneficiary, we kind of lose a year because we need to have had, our entitlement arises. We know all those aspects of it. So therefore, we need to have our loan agreement in place by the lodgement date for the next financial year. And our first minimum yearly repayment is due in that next financial year, being 30 June 2024. So I guess there's an opportunity there. It doesn't necessarily always work that way. In my experience, most trust or corporate beneficiaries receive, the balance of net income or something similar, rather than being, I guess, one of the the primary or first beneficiaries to receive set amounts. It may be the case that is how some people do it. But understand that if we make a company presently entitled to a set figure, then we're going to lose a year in when we have to start making repayments. So we'll need to make a repayment in that next year rather than the year after. So with the subtrust option, if we make the trustee or the trustee of the main trust sets aside $50,000 on subtrust, at 1 February 2024, the trustee of the trust uses the subtrust fund effectively for its main trust purposes. That is the date at which the financial accommodation is made, which gives us, again, that further year in order to put in place our complying loan agreement. So we've got lodgement day for this for that company being 15 May 2025. Again, we have to make our minimum yearly repayment by that end of that financial year. I have a bit of difficulty with this particular slide because, as we know, if I guess in this scenario, they're saying that the trustee has that $50,000 perhaps in his bank account and sets it aside on trust. In most circumstances, that money's probably tied up in the business. It might be in, debtors, for example. Where it is in debtors and things like that, my view would be that it's immediately used by related parties. So you may find that this slide, depending on whether or not that amount is available to be immediately set aside and hived off from the main trust, if it's unable to be put into a separate account, for example, then you may find that the provision of financial accommodation actually occurs on 30 June 2023. So a little bit of care on this slide with this scenario needs to be put in place. So look, I think that is my final slide. So this new ruling doesn't change. It does change a lot. It changes how we've come to know subtrusts. If your clients are using them, it changes how that works and what the landscape looks like. It does make Division 7A loans, both 7 and 25-year loans, really the way forward, where we don't have the cash to pay through our entitlement. If we have an amount, again, not really sure why you would have a subtrust if you had the money sitting aside. You may as well pay the money through in those circumstances. However, we know that from what I've kind of talked about, there has been a significant change there. As soon as those subtrust funds are used for purposes other than or by anyone who would be an associate of the company, that will be the provision of a Division 7A loan. They have said that compliance resources will not be devoted to pre-1 July 22 subtrust arrangements. Obviously, what that means, and I think Adrian will have a view similar for Section 100A, is that they're going to use these when they're auditing for perhaps a different purpose and they come across it. I don't envisage an actual program of compliance on this particular topic, but certainly it will be used, if they're auditing for a different purpose. Comments still available on the ruling, but my personal view is that we're not going to see any changes, certainly nothing substantial from what's in the document now. And the current rulings are going to be withdrawn with effect from 1 July this year. So look, this is the way forward. The ATO, in our view, is getting ahead of the government because they're sick of waiting and they're sick of having to amend their practice statement saying that if you get to the end of your subtrust life, we'll let you put it on a loan. And they've changed their view. They say because case law has changed their view. I'm not so. They may genuinely believe that, but many others wouldn't. So that's all I have. If you have any more questions, please shoot them through.
There's plenty of questions, Paul. You ready for them?
No.
What is the situation for existing subtrust arrangements? When do we need to have them treated as Division 7A?
Existing subtrust arrangements will simply run their course. There doesn't appear to be. There's nothing in there to say that if you entered a subtrust arrangement last year, for example, and you put in place the required documents and the like, that will run its course. You don't have to convert them under this new ruling.
Do secured Division 7A loans still apply?
Yeah.
So 25-year loans?
Yeah, absolutely. Yes, that area of law has been suggested to change that, but that legislation has been on hold for about 4 years now. So in my mind, there's no reason not to use them if you can. Don't wait for the government to change the law.
If a percentage distribution is made to the company, what happens if someone associated with the company draws on an amount of money before the distribution amount to the company is determined?
Well, there is no provision of financial accommodation until the amount is determined. However, and this is probably something I've been speaking with a few accountants lately, there are other provisions to kind of capture those amounts. So you've got subdivision EA, which deals with the situation where you have an unpaid present entitlement to a private company, and the trustee then lends to a related party. So those circumstances are already captured within Division 7A. So I guess the short of it is, if there's an unpaid entitlement to a company, whether you've determined the amount, the dollar amount or not, you should be very wary about the trustee making payments to related parties, payments or loans to related parties, because that will be captured by Division 7A.
Okay. How long after we determine the amount owed to the company must that distribution amount be paid to avoid the need to create a Division 7A loan?
Effectively, you've got that 18 months. So it will, if the amount, if we go back a couple of slides, if the amount is determined in August, for example, that's when the financial accommodation is provided. You then have until the lodgement time for that financial year. So if we take this year, for example, lodgement time for, I'll take next financial year. Lodgement time for the 2024 year will be that May date. So you effectively get a little less than 18 months before you have to actually pay it or put in place a loan.
Okay. Has there been any change in the loan agreements? By that I mean, do we need a loan agreement for each loan, or can there be open-ended loan agreement applying to all of the loans, so the amalgamated loan?
Yeah. Look, my view would be that you need a separate loan each year. A lot of constitutions of companies have a scheduled loan in the back of the document so that you can simply sign an acknowledgement, for want of a better term, saying that this amount will be a loan in accordance with Schedule 2, which is a Division 7A loan agreement. My view would be having separate loan agreements, because every audit we've ever had, they want to see paper.
Can you confirm that we can still use Subtrust for 30 June 2021 and 30 June 2022?
Yes.
And last one, Paul, before we let you off the hook for the time being. Do quarantine UPEs existing at 16/12/2009 become exposed to Division 7A? And do we need to put them on a loan agreement? If so, by what date?
Short answer is no. No, they don't. With one exception, and I had a conversation with an accountant this week, and it's a little bit about what I said earlier about if the trust makes payments or loans to related parties of the company, those loans are still caught by Division 7A. They're caught by that subdivision EA that I was talking about. And I think, unfortunately, for the large part, I think when we talk about quarantined, we think we can kind of just ignore them. All the quarantining did was say that TR 2010-3 or having to put that amount on a loan agreement wasn't you didn't need to do that. It didn't absolve all of Division 7A. So I think that is a bit of a sleeper. So if you've got quarantined UPEs and you're making capital distributions to related parties, you do have Division 7A consequences for those. In terms of putting those loans on, those UPEs on loan agreements now, no, you don't have to.
Thanks, Paul. We'll move on to the next part of the presentation, which is on the 3 Section 100A releases. If you haven't already been to a few webinars, no doubt you've read the various newspaper reports or alerts about the updated ATO attack on trusts. I mean, in our experience, the ATO have been using Section 100A in audits where there's a trust involved for the last 5 or 6 years, at least. They like to use it as a potential issue for a couple of reasons. One being that it has an open-ended amendment period. There is no time limit on amendment under Section 100A, so we've seen it used for very historical matters. And the other aspect of it is when you actually get the numbers, or you work through the numbers, considering that the trustee is taxed again at the top marginal rate, you end up with some fairly frightening new tax assessments. And if they're of a historical nature and backdated some time, then you've got a lot of interest and penalties on top of those. So certainly something that they've been saber rattling for a while now in terms of audits that we've come across. They don't tend to actually implement it, but it's a very big stick that they like to wave around. So a variety of industry bodies have been asking for certainty on 100A, and there has been a program to rewrite the old guidance on what the ATO consider ordinary family and commercial dealing with some new guidance. That's been delayed somewhat by matters before the courts, including the Guardian decision, which came out recently. But they've now released some material. So we've got Taxpayer Alert 2000, and it should be 2021, not 2002. Sorry for that typo. Draft Taxation Ruling D1, 2022, and Draft Practical Compliance Guideline in terms of Section 100A. So we're going to cover off on the Taxpayer Alert, have a look at the ruling. Not going to spend a lot of time on the PCG, but we'll just touch on the main areas. So hopefully we can get to that wisdom section that Paul spoke about. So taxpayer alerts, the ATO tend to issue taxpayer alerts as a bit of a marketing exercise, in my view, where they've seen something that they don't like. So they'll issue a taxpayer alert, knowing that they will get compliance from a certain percentage of tax agents and taxpayers who will automatically, if they're thinking or doing something similar to what's in the taxpayer alert, they'll stop doing it. So that's one of the reasons that they issue taxpayer alerts. It's a bit of market conditioning, and they're quite open about that if you ever talk to anybody from the tax office of a senior level. In terms of taxpayer alert 2022-1, it's dealing with reviewing trust distributions by parents to their children over 18. And the ATO state they're concerned with arrangements to avoid tax by utilising persons with a lower tax rate, where the benefit is enjoyed by the parents. In terms of the alert itself, as I said, they're usually issued when the tax office has come across something out there in the real world. So I would suggest they've come across at least one of these sorts of scenarios where we've had somebody implementing this sort of transaction and then trying to justify it by the facts that they kind of outline in the taxpayer alert. So whether that was one taxpayer or a suite of taxpayers, clearly there has been some sort of effort to try and dress up something that wasn't in order to address Section 100A. So in terms of the benefits that they say that the taxpayers are deriving, they say the children are paying for expenses ordinarily met by the parents. Don't really see that as a benefit. The children's entitlements are applied for the benefit of the parents, either directly or indirectly through excessive charging, and that there's an element of contrivance in the situation. So the features of the arrangements that they're talking about is ones that display all or most of the following. So we have the parents in control of the trustee. The income of the trust is used to meet expenses of the parents. The children are made presently entitled to income. The entitlements are substantial but don't exceed the magic $180,000 mark, so we don't go above that percentage in terms of tax rate. And the income is not paid to the children but paid or applied to the parents. And they go on to say, and this is really where they're aiming at in terms of the taxpayer alert, that the parties contend, so when they come under audit or review, that the children are required to repay for expenses related to their upbringing, or the children are required to repay their parents' costs of living exceeding a reasonable amount. And there's an agreement that the parents will manage the pooled entitlements. So I guess, the simplest way to talk about this taxpayer alert and the sort of arrangements that they've come across is we've had all of these distributions to children. We've then had some documentation prepared that say, it's to repay expenses for the last 18 years of your life, or it's paying for school fees, or it's paying board that's above market rent. I think it's a bit of a lesson in not trying to be a little bit too smart in producing these extra documents. But clearly these sorts of arrangements in terms of where you try and then document these things to try and get around 100A, in reality, you're putting yourself back in the firing line. And I'll make some comments in terms of the ruling as well, generally, on this, because the ruling relates to these sorts of arrangements too. But in reality, my view would be it's not going to stop what you have been doing in practice and what you will continue to do. I think it was just more about trying to stop these sorts of more elaborate documentation to try and address these 100A issues. They list some exclusions to the taxpayer alert. Child being made presently entitled to income, which is used to repay legitimate expenses. Child receiving the income and benefiting from the income, but I don't know why that needs to be an exclusion. You'd hardly say that's a reimbursement agreement under Section 100A, but they include that in the taxpayer alert. One thing to notice, and like with most alerts, it's not just relating to that factual scenario when they say it can apply to other scenarios. So not just relating to distributions to children, it could relate to distributions to low tax entities or loss entities, or other family members such as grandparents that have a lower rate of tax. So they do obviously make that clear in the taxpayer alert.
Adrian, yeah, just to let you know, there's probably 4 or 5 questions all on that point, just saying like, can adult child distribute to their elder parent without these problems, and similar questions like that. Yep.
So they do say that it could be caught by the taxpayer alert, and I will make some comments generally on what the sorts of family situations I would think are okay. And I mean, one of them is distributing to elder grandparents, but I'll come back to that when I talk about the tax ruling, because that goes into more about when they think they will apply Section 108 situations. In terms of in consequences, if they think are subject to the taxpayer alert or you've got a scheme similar to it, they're going to apply 100A. In terms of other issues there, and obviously causing a bit of angst amongst tax agents, is also the suggestion that perhaps they will apply the promoter penalty provisions if you're rolling this out amongst a few clients, and also that referring tax agents to the tax practitioners board who have entered in these sorts of arrangements. We have seen that in practice, where the ATO at the end of an audit that has ended in a settlement has reviewed the tax agent to the tax practitioners board. No action was taken by the tax practitioners board, but should be aware that they are using this or using material gathered during the audits and reviews to then refer, because if we've seen it once, it's happened more than that, to refer tax agents to the TPB. So again, marketing, conditioning, trying to get you a little bit frightened about what you're doing, but hopefully we can give you a little bit of comfort, or if not, you might want to think about not following these sorts of things or restructuring the trust out of a company. But as I said, I'll talk about that a bit more when I get to the ruling, which is next. So Section 100A, as we said before, if we have what's called a reimbursement agreement, it applies to make the trustee rather than the presently entitled beneficiary liable to tax. You don't get a refund on that tax that they've paid. It's a separate tax charge, unlike things like Part 4A, where you have a compensating adjustment. So it can, in effect, lead to double taxation, a fairly hefty tax rate if it is applied. In terms of the ruling, and this ruling, as I said, was really delayed by the Guardian case, which we will touch on at the end of the ruling. But this is the ATO's views on when they think Section 100A applies to trust distributions. So they go through a few what they call requirements for Section 100A to apply, and then they provide some commentary on what they think is ordinary dealing, because what ordinary or family commercial dealing? Because one of the exceptions in Section 100A and subsection 13 from memory is if the arrangement is in connection with ordinary or family commercial dealing. So we can have all of those other, and there are a number of other things that are required for 100A to apply. We need to have a reimbursement agreement. We need to have somebody presently entitled. We need to have a tax benefit or a tax reduction purpose, as the ATO say in this ruling. But even if we have all of those, if we can show that it's in relation to ordinary and family commercial dealing, then 100A doesn't apply. So just because we have a tax benefit due to the way that we're making our distributions, it doesn't necessarily flow that Section 100A applies. Of course, the tax office would like you to think that it will apply, but I can tell you from personal experience, when interacting with ATO officers, when they bring up 100A as a concern, more often than not, they have never actually read the provision. So they have been told to bring it up as a concern. They may not have actually independently applied it to the facts. Similar when they say at the end of most position papers or reviews, we also think Part 4A may apply. Part 4A may apply to any tax transaction, no matter how vanilla. So it's fairly pointless saying that. But of course, we need to be aware of what the ATO views are and what they're likely to say based on the ruling. So the connection requirement that they say is that 100A will apply to trust income where a beneficiary is either in fact or deemed presently entitled to income, and it's arisen out of a reimbursement agreement or by reason of any act or in connection with the result of a reimbursement agreement. So there has to be a connection between the reimbursement agreement and the present entitlement. There always had to be under the legislation, so it's a no-brainer to say that there needs to be that connection. And certainly, I mean, one of the things that the tax office sometimes try to run in these sorts of historical 100A matters is that, and I've seen it, something that happened in 2008 was connected to something that the taxpayer did in terms of present entitlement in 2016. Clearly, it can't be, but at least they acknowledge that there has to be a connection between the reimbursement agreement and the present entitlement. In terms of the reimbursement agreement itself, they state it can include arrangements, understandings, can be informal, express or implied, no requirement for it to be enforceable, and no requirement for all parties to understand or be a party to the agreement. It's an interesting concept. You don't understand the agreement and you're not a party to it, but there's still an agreement. I'd like to see that be enforced in a court of law if you're trying to, well, I guess that's why they say it doesn't have to be enforceable. And can be a plan of a series of steps. I mean, in essence, in terms of the concept of an agreement for the reimbursement agreement, they're trying to cast the net as wide as possible in terms of trying to capture all scenarios. Some people who are much smarter than me have in the past taken the view that there can never be an agreement for the purposes of Section 100A because a distribution of a trust income is a unilateral decision by the trustee. So there is no agreement. I've always had problems with that view. And I think, in terms of the tax office approach, it's clear here that they're going to try and say anything is really an agreement if we can see a series of steps even. So I don't think that has much legs in terms of that argument, and particularly the ATO won't agree with it. Connection between, again, the relevant connection between the agreement and the precedent entitlement. We've already been through that, so I won't run through that again. There must be a benefit to another. So in terms of historically and in the past, the kinds of benefits would be, you distribute income to somebody with the understanding that they will repay that to the trust or lend it to somebody else. Also, not demanding repayments can be included or can be part of Section 100A as part of the steps according to the tax office. So that's the sort of scenario where the trustee distributes to a beneficiary and the beneficiary doesn't call for it. They're saying the benefit is to the trustee in that situation. And we have the tax benefit to the trustee because that's really what they're looking to show, because that's one of the elements of Section 100A. Tax reduction purpose. So they do list in the ruling what they consider to be tax reduction purposes. So they say it's entered into for the purpose of one or more of the parties to the agreement to pay less tax than otherwise would be payable. It does need to be the sole, dominant or continuing purpose. Can include deferral of tax to a later income year. Classic tax planning is tax deferral. Interestingly, they say the tax benefit is not required to those party to the agreement. Again, I'm not really quite sure how that works in terms of how can we have a reimbursement agreement which has a tax benefit provided to somebody who's not a party to the agreement. But again, casting the net wide in terms of what they say would be a tax reduction purpose, because we do need that purpose in order for Section 100A to apply. Now, coming to really what the main reason that people will use in fighting a Section 100A position or an assessment is that ordinary family or commercial dealing. Now, the tax office has tried in their ruling to really limit what they consider to be ordinary. They have, and we'll talk about Guardian, they've taken a beating in the first judgment of Guardian. They were waiting on that decision, no doubt in the hope that it would go with the tax office at first instance. It didn't. So what they've done here is kind of tied them, in my view, tied themselves up in knots a little bit to say that they accept agreements entered into the course of ordinary family or commercial dealing are not reimbursement agreements. That's nice to know, considering there is that exception. That's nice they accept that. But they say the essential features of that, it's capable of explanation by familial or commercial objects that they are to achieve. The appearance of tax-driven motives are relevant to say that it's not ordinary family or commercial dealing according to the tax office. And it's not an ordinary dealing merely because it's commonplace or involves no artificiality. So I guess in terms of that saying it's not ordinary because it's commonplace, I did have to go to the dictionary and a thesaurus to have a look at the definition of ordinary. Strangely enough, it does include the word common in that. So I think that's a fairly untenable position to say something just because it's common doesn't make it ordinary. In terms of this exception, as I said, this is really where you would be looking to defend a Section 100A sort of position from the tax office. And I'll make a few comments on that based on defending it, as well as also the taxpayer alert. So with what would be ordinary family or commercial dealing, the tax office still have the issue that all of the cases that they rely on are historical cases where there were really blatant tax schemes involved. certainly they're not ordinary family or commercial dealing. And Guardian decided this year doesn't help them in terms of what would be ordinary family or commercial dealing. And I would say using a trust and distributing to children, absent of all of what I call the window dressing in the taxpayer alert, whether you've got suggestions that it's used to pay historical expenses and those sorts of things. Distributing to a child, leaving it unpaid on the basis that the family pays less tax overall, I would say is ordinary family and commercial dealing. And I take that on the view that your justification is you are building wealth for the family that the children will eventually take over, because if the parents pass away, the children will take over the trust, that the children will take over. They're contributing to the growth of that family wealth. And I would say that's your ordinary family or commercial dealing right there. To use a different example, if you have a wage earner that acquires a property that is negatively geared, why do they do that? If you ask 99 people, well, ask 100 people, 99 of them would say, I do that to get the tax deduction. But it's not to get the tax deduction, it's to grow your wealth. That's why you're acquiring the property which is negatively geared. I think you can use the same sorts of analogy and the same sorts of argument here to say, as a family group, we are growing our wealth. We accept that we're paying less tax. That is a feature of the distribution. It's within the law. We are growing our wealth, paying less tax. That's our ordinary family. You may also have the situation where in some cultures, not your normal Caucasian Australian culture, but in some cultures, it's quite normal and it's quite ordinary for children to look after parents and vice versa. So, or grandparents. So again, I think you do have strong grounds to have that argument with the tax office. And I think you would win in that scenario. As I said, absent of any of what I call the window dressing. So let's not, in my view, let's not overcomplicate things by having these other ancillary documents and, gifts and loan backs and all of those sorts of things. Let's just call it the way that it is. And I think that's the safest course of action moving forward if you're continuing to distribute to children. Consequences, again, assessment on the trustee. So it's fairly negative in terms of outcome for the taxpayer. In terms of the date of effect, the Commissioner proposes that the ruling will apply to arrangements both before and after its issue. So they're saying that what their view is now will apply to things that you have done in the past. In the PCG, there are some carve-outs for that, but I'll make some comments on that when I get to the PCG. I just recognise the time. I mentioned Guardian. It's a judgment of the Federal Court, Justice Logan. It is on appeal, so we will be having an appeal from the full Federal Court at some stage. If you haven't read the judgment, I won't go into any of detail because of time. Justice Logan, who was the presiding judge, if you're a taxpayer, he is a good judge to get because he's what you call a black letter lawyer, in that he's not swayed by the vibe or marbo, to use that classic phrase from the castle. He looks at the legislation, looks at the facts, and applies from there. So in terms of what he held in Guardian, and it was very well set out in terms of the evidence of the client and the accountant as to why they were making these distributions. He said that the reimbursement agreement must be in existence before the present entitlement. A connection based on legal or factual hypotheticals is not enough. And in that case, in Guardian, risk minimisation was an ordinary family or commercial dealing. So, of course, the full Federal Court may take a different view, but I think at this stage it's showing that what the tax office tried to show is not ordinary family or commercial dealing is, and they're really pushing the proverbial uphill in many cases, I would think. Very quickly touching on the PCG. In terms of what they are, is the documents which are meant to give the guidelines of what the ATO's compliance approach will be. And in this document, they talk about white zone, green zone, blue zone, red zone. Paul touched on it before, but I think in practice, I wouldn't even bother with the PCG in terms of thinking, okay, well, I'm in a particular zone, that should be fine, because my experience with PCGs is that if you're in an audit for something and they want to expand to another area like 100A, and you say, well, no, this is clearly in the white zone, for example, they'll ignore that and say, well, it's not, it's now in the red zone because we're auditing you about something else. So although it's nice to have a little bit of guidance in terms of what they consider as different areas of risk in terms of Section 100A, I don't think it's anything that you can practically rely on in terms of ATO audits, because, as I said, my experience has been they'll always find a way to ignore the guideline where it suits in terms of that. So I'm not going to, all of this is in your notes in terms of what the different zones are. I'm not going to run through them, and I hadn't intended to, but there are some examples there of the different zones. The red zone, some of us live our entire lives in the red zones quite happily, but clearly the commissioners there is trying to point out some things that they would not like you to do, and provide some examples there within the PCG. As I said, I wouldn't spend a lot of time reading it because it gives you no comfort that if you're sitting in a particular zone, the tax office isn't going to still audit you or take a different view when they do audit you. Again, with all the documents that are in draft, the Commissioner is inviting comments. I would think it's not likely that they will change great swathes of the documents in terms of the ruling or the PCG. I would think, generally speaking, comments they tend to use as seeing where the arguments would be raised in any sort of live audit. So I wouldn't expect it to change too much. They've also said that they're looking for test cases. So if you've got any clients out there who want to throw their hats in the ring and subject themselves to a 5 to 10 year test case program, there's a number there on the PCG if you want to give them a call. Of course, I do not suggest that for any of your clients, but that offer is there.
Adrian, believe it or not, there are a few questions. First one, will testamentary trusts be included in this regime?
Yes.
Okay. In relation to the documents, what's your view on grandparents paying their grandchild's school fees from their UPEs?
It's the same as really any sort of family situation. If the grandparents actually receive that cash and then decide to pay the school children's fees, I don't see an issue with that. The reality is that it's quite common for grandparents to do that. Many clients that I have, they pay their grandchildren's school fees. Many clients that I have established trusts or established their estate plans so the grandchildren's school fees can be paid. It's ordinary family or commercial dealing, or ordinary family dealing, I should say.
Is there an option to have trust distribution to a company and then frank dividends to adult children as shareholders?
Yes, of course. You need to consider the UPEs separate to Section 100A, but certainly there is that option. What they don't like, and it's been spoken about for at least 15 years from memory, is the washing machine arrangement where you make the distribution to a company, you declare the frank dividend to a trust, and then the trust then distributes back to the company. If you get your timing right, Division 7A doesn't apply, but certainly, and I would agree, Section 100A would apply in that scenario.
Will Section 100A potentially apply to the forgiveness of pre-09 UPEs to corporate beneficiaries?
No. And the reason for that is that you have to have your reimbursement agreement at the time you're made presently entitled. So you would have to show that when you made your distributions before 16 December 2009, you had an agreement or an understanding that on the 25th of March 2022, you would forgive it. Unless you're very good at planning, you're never going to have that agreement or reimbursement agreement in place at the time you're made presently entitled.
Thanks. If parents have, I'm going to add a few words here because I think I need to add some for the question, but if the parents have funded the purchase for a house for their children, can trust distributions essentially distributed to children be taken by the parents as a repayment for that house loan?
I would, again, say yes. Yeah, I said, we don't want to make things too complicated and dress it up, and quite often the simpler approach is the best. But if that's the factual scenario, that they had previously provided funds to the children, bearing in mind that whenever you have a family member giving funds to another, it's at law, it is a gift unless it's documented otherwise. So we would always suggest that parents, if they're giving or lending money to children for house purchases, that it's by loan, but you would need to have that in place before. If that's the factual scenario, I don't see an issue with it.
There's plenty more questions, Adrian, but I'm conscious of the time. So what we might do is reply separately in relation to those questions.
Sure.
So yeah, thanks everyone, and thank you, Adrian. I know 100A is probably, like I said at the beginning, what everyone probably came for. It is an area that is, these publications have created a lot of fear, particularly in accountants, that things we've been doing for a long time are now suddenly, with the stroke of a pen, ruled out. I think it's a bit more nuanced than that, and I think as much as we like to stay within the green zone for to use their analogy, I think they're being a little overzealous in relation to a lot of these activities. But if you've got any questions or you've got further things you need help with, let us know, and we can help you be guided through it. In your feedback email, which will come out shortly, we'll let you know about our face-to-face LRC workshops, which are back on this year. We're running those in the early to mid part of June. We've got Brisbane and the Gold Coast in the first week of June, being 1 and 2 June. Melbourne on the 8th of June and Sydney on the 15th. So we're looking forward to getting out and seeing everyone face-to-face. And we will be talking about these topics again, but also how do you get, I guess, out of these structures if these issues are really concerning you. So we're looking forward to that, and we'll see you next time.
Before you, just for the WA people in attendance, because I saw a few, unfortunately, due to capacity restrictions and concerns about border controls, we won't be making WA in June, but we'll be looking to host an event there as soon as things loosen up a little bit.
Great. All right. Thank you very much.